When you're analysing a chart before you make an investment, things aren't always as they seem. Hello and welcome to today's Daily Blitz. In today's video we'll be going over a particular chart crime which you'll often see perpetrated by those in the financial market. So to start off with, this is a chart of the Dow over 100 years. And Nikolai, that looks like a pretty good chart to me, right?
Yeah, I bet you wish you invested in that.
But behind the scenes, or there is at least one detail that is being deliberately missed out in the creation of this chart.
Right, the first factor that I think people should be aware of is inflation. If you inflation adjust that chart of the Dow, the performance is nowhere near as good. The second thing to adjust for is that, say, a 5% gain 100 years ago looks very different to a 5% gain today. And so the way to adjust for that is something called logarithmic charts. Once you make those two adjustments, the chart of the Dow going back 100 years, as you can see on the screen now, looks completely different, and the stock market performance looks nowhere near as good.
Now, in terms of inflation adjusted, why do you think that's often left out?
Basically, to make the stock market look better. There's no other particular reason. A more honest chart would factor in inflation.
Now, and you can do this for the majority of stock market indices, correct?
That's right, yeah.
Yes.
Especially when there's longer time periods involved.
Right. And logarithmic charts, now why is it that traders and investors use them in general? Because they are something that's generally seen as the more sort of nerdy, geeky side of financial market analysis, really.
Yeah, so because of inflation and because of the long periods of time we're talking about, all charts will naturally look exponential if you look at them without the logarithmic adjustment. What the logarithmic adjustment does is it takes away that exponential growth effect, that curve, and returns the market to a more honest form, where if you'd invested 100 years ago, it's comparable to if you invested 50 years ago or if you invested 10 years ago. It makes that comparison accurate in terms of how the chart is displayed.
So if you take both of those adjustments in mind, you view a chart of, say, the FTSE or the Dow in a logarithmic manner, and you also have it in inflation-adjusted chart, you'll find that these charts look an awful lot different than they're often portrayed within financial media and by financial market commentators in general. It is often quite a lot easier to display a chart without those adjustments, which is probably why they happen quite so much. But they can be very deceiving, so you should look out for it. But there you have it, folks. Thank you very much for watching today's Daily Blitz, and be sure to tune in next time.